By mid-2026, the trading floors of traditional finance have fully absorbed digital assets. The old barriers between Wall Street and the blockchain are gone. Pension funds, family offices, and legacy wealth managers are now managing substantial allocations in the space. Spot Bitcoin ETFs serve as the primary vehicle, turning a once speculative experiment into a standard line item in conservative portfolios. The industry expected this flood of institutional capital to bring immediate, limitless growth and steady the historically erratic markets. But the promised stability hasn't materialized. Instead of a smooth ascent, the market continues to grapple with intense volatility and persistent investor anxiety. Despite billions of dollars flowing through these new institutional pipelines, upward momentum is stalling out. We are watching a live structural audit of the industry. The market is undergoing its first true institutional stress test. The outcome now hinges entirely on whether this newly built foundation can hold up under the crushing weight of an unforgiving global economy. Two massive structural upgrades are actively supporting the market. The first is the newly implemented U.S. federal stablecoin framework. With clear rules finally in place, large banks and payment processors now have the legal confidence to expand their blockchain operations without the constant fear of sudden regulatory enforcement. The second major support pillar is a mechanical shift in Bitcoin's supply dynamics. Investors are rapidly pulling Bitcoin off centralized exchanges and locking it into cold storage, draining the available supply. And while supply contracts, massive new volume from ETF pipelines is forced directly into the system. According to basic economics, combining clear regulations with shrinking supply and heavy institutional demand should force prices upward. But integrating into traditional finance means absorbing traditional problems. The asset class is now tethered to global economic anxieties. Across the broader economy, bond yields are rising, and central bank policies remain unpredictable. This dual-axis chart tracks the resulting fallout. As bond yields climb, ETF capital inflows spike downward. When traditional markets get nervous, institutional investors quickly liquidate their risk on assets and take profits. That is the trade-off of institutional adoption. Broad exposure has made the digital asset sector highly vulnerable to traditional economic panic. External macro pressure is only half the problem. The industry is also wrestling with its own lingering internal flaws. A recent wave of heavily hyped AI-focused cryptocurrency projects failed to deliver any meaningful technological innovation. The project treasuries and founders benefited, while retail token holders absorbed massive losses. At the same time, researchers continue to track unresolved security vulnerabilities embedded within decentralized finance and Ethereum staking ecosystems. These ongoing failures signal to institutional managers that beneath a polished corporate veneer, the sector still battles the reckless, speculative habits of its past. We are left with a perfectly deadlocked market. Institutional accumulation is pulling in one direction, while macroeconomic fear pulls in the exact opposite. What this deadlock proves is that the era of digital assets operating as an isolated financial island is over. The streams have fully merged. Because it is now deeply embedded in the traditional system, when the broader global economy bleeds, this market bleeds right alongside it. The standard for success has changed. Technological innovation is no longer enough to carry the market. The asset class must now demonstrate macroeconomic resilience. The remaining months of 2026 will lock in the permanent financial identity of this industry. Either long-term institutional buying will outpace short-term economic fear, or the gravity of traditional finance will force another brutal cycle of consolidation. Surviving this stress test will solidify cryptocurrency as a mature, durable asset class. Failing it will prove that it remains entirely at the mercy of the traditional financial forces it once set out to replace.